The trade dispute between Canada and the United States has become a defining moment with the potential to reshape the global economy, particularly in sectors such as automotive, energy, and agriculture. What initially began as a ripple effect of President Trump's protectionist tariffs has now evolved into a full-scale confrontation, affecting not only North America, but global trade at large. Canada's recent proposal of a 100% tariff on Tesla vehicles has sent shockwaves through the automotive industry, signaling a profound shift that could impact the broader economy for years to come. This article explores the potential ramifications of this trade war and its effects on industries and countries worldwide. The US and Canada have long shared a close trading relationship, especially in the automotive sector, where they exchange billions of dollars worth of cars and materials such as aluminum and steel each year. However, since the Trump administration imposed tariffs on various Canadian imports, Canada has been under increasing pressure to retaliate. The proposed 100% tariff on Tesla, a symbol of American innovation in the electric vehicle (EV) market, has the potential to disrupt not just the automotive trade between these two countries, but also the global trade landscape. Tesla has long been a leader in the EV revolution, holding around 70% of the US electric vehicle market. A tariff of this magnitude would likely raise the price of a Tesla in Canada by $5,000 or more, making these vehicles less affordable for Canadian consumers. As a result, many consumers may turn to alternative electric car brands, particularly those from the European Union, which could be exempt from these tariffs. This shift could tilt the balance of power in the EV market, giving European brands a significant edge over American automakers in Canada, and potentially spreading to other markets as well. While Tesla would bear the brunt of the tariff, the consequences would extend far beyond the company. Canada's automotive sector is deeply intertwined with the US, and any disruption in trade could have a domino effect. North America's auto industry produces over 2 million cars annually in Canada, many of which are exported to the US. If a 100% tariff were to be imposed, it could severely disrupt this trade flow, leading to factory shutdowns, widespread job losses, and strains on global supply chains. The direct effects on Tesla would also be significant. The company could experience a sharp decline in stock value due to lower sales and reduced profitability, which could further hinder its long-term prospects in North America. For investors, this might signal the beginning of a downturn in the EV market, making future investments in the sector more difficult to justify. This, in turn, could slow the overall growth of electric vehicles, undermining efforts to promote green energy and sustainable transportation at a time when these investments are urgently needed. Canada's decision to impose retaliatory tariffs on U.S. goods is more than just a reaction to the tariffs on cars. It reflects a broader strategy aimed at diversifying Canada's trade relationships and reducing its dependence on the U.S. The U.S.-Canada trade relationship is valued at over $800 billion annually, and any disruption to this flow could have serious consequences for both economies. Rather than backing down, Canada has taken bold steps to safeguard its economic interests, including imposing tariffs on key U.S. exports such as steel, aluminum, and agricultural products like beef and dairy. But tariff imposition is just the beginning. Canada has also aggressively pursued strategies to lessen its reliance on the U.S. by signing new trade agreements with the European Union, countries in Asia such as Indonesia and Ecuador, and even strengthening ties with emerging markets. These efforts to open new markets will not only benefit Canada's economy, but will also challenge the U.S. by weakening its grip on its closest trade partner. Canada's recent strategic moves include significant investments in critical sectors like energy and technology to reduce reliance on China. In collaboration with the EU, Canada has formed a new strategic minerals alliance designed to secure the supply of crucial materials such as lithium, cobalt, and nickel, essential for electric vehicle batteries and renewable energy technologies. This alliance could disrupt China's dominance over the global supply of these materials, shifting the balance of power and providing Europe and Canada with greater leverage in the evolving energy and technology sectors. In conclusion, the ongoing trade conflict between Canada and the U.S. is more than just a diplomatic clash. It is a pivotal moment that could reshape the future of global trade. With far-reaching consequences for the automotive industry, supply chains, and geopolitical dynamics, the world will be watching closely as this trade war unfolds and its ripple effects continue to unfold across industries and borders. The new alliance between Canada and the EU holds far-reaching implications, not only for energy independence, but also for the global transition to green energy. By establishing a reliable supply chain for essential minerals, Canada and the EU are positioning themselves as key players in the future of energy production. This shift could challenge the dominance of the U.S. in critical sectors. The impact of this partnership will be felt worldwide, particularly as demand for electric vehicles and renewable energy solutions continues to rise. Canada's move away from U.S. dependency is not limited to tariffs and trade agreements. The ongoing tensions between the two countries have prompted Canada to explore new, more diversified markets, particularly in Europe and Asia. Canada's long-standing economic reliance on the U.S. is changing as it seeks to reduce its exposure to U.S. protectionism and increase its trading relationships with other global powers. The Canada-European Union Comprehensive Economic and Trade Agreement, CETA, has already driven trade to new heights, reaching a record $100 billion in 2021. However, the most significant development lies in Canada's shift in energy exports. Historically, about 97% of Canada's oil has been sold to the U.S. Now, with new agreements in place with countries like Japan and China, Canada is diversifying its energy exports, thereby reducing its reliance on the U.S. market and expanding its global energy presence. This strategic shift challenges the U.S.'s position, as it now faces increased competition for access to Canada's energy resources. The trade war between Canada and the U.S. has not only affected industries like automotive, but has also had significant repercussions for U.S. agriculture. U.S. farmers, who have traditionally relied on Canada as a key trading partner, are now grappling with a crisis. Canada has imposed tariffs on essential U.S. agricultural exports such as corn, soybeans, and beef. These tariffs have made it much harder for U.S. farmers to sell their goods in Canada, leading to a drop in prices and financial strain for many farmers. As a result of these retaliatory tariffs, countries like China and Mexico have seized the opportunity to increase their agricultural exports to Canada, further compounding the difficulties faced by U.S. farmers. The long-term effects could be devastating, as many farmers may be forced to sell their land to large agribusinesses, contributing to further consolidation in the industry and the decline of small family farms. One of the most critical vulnerabilities exposed by the trade war is the U.S.'s heavy reliance on Canadian energy supplies. Canada is the largest supplier of oil to the U.S., accounting for around 60% of its oil imports. Additionally, Canada provides substantial amounts of natural gas and hydroelectric power. If Canada were to cut off these energy supplies, the consequences would be severe. Energy prices would surge, causing industries that depend on stable energy prices, such as manufacturing and chemical production, to reduce output or even shut down. Furthermore, the U.S. could face energy shortages as it scrambles to find alternative sources of oil, natural gas, and electricity. This disruption would not only destabilize the U.S. economy, but also affect the global energy market, as countries around the world compete to secure energy supplies from Canada. The escalating trade war between Canada and the U.S. represents a significant shift in global trade dynamics. As Canada strengthens its alliances with the EU, Asia, and other emerging economies, and diversifies its energy exports, the U.S. risks losing its dominance in the global trade landscape. Canada's proactive approach to securing its economic future through expanded trade agreements and strategic alliances is reshaping global markets. The pressing question now is whether the U.S. can adapt to these changes, or if it will be left behind in a rapidly evolving